Thank you for standing by, and welcome to the Orocobre 2019 full year results briefing. I would now like to hand the conference over to Mr. Martín Pérez de Solay, Managing Director and CEO. Please go ahead.
Thanks, Lexi. I would like to welcome you all to Orocobre's financial year results briefing for the year ending June 2019. I would like to open the call with some comments on safety. As I will discuss in more detail later on, safety is the first of three areas of focus for our business. I am certain improvements in safety will lead to improved operational and financial results. The operations achieved a TRIFR of 3.5 at Olaroz and 3.8 at Borax for FY19. These results are slightly worse than FY18, as we had a number of incidents in the first half of the year. However, some of this also relates to improved reporting. Safety must be a focus at Olaroz as we move into inherently more risky construction activities. At Olaroz, the number of safety observations and audits has been increased to ensure that all proper safety procedures are being fulfilled by both Sales de Jujuy staff and contractors. At the end of June, the Borax Tincalayu mine had achieved 795 days without an LTI, and the Sijes mine had achieved 137 days without an LTI. A single LTI was recorded at the Campo Quijano plant at the start of April, and following that, Campo Quijano achieved 89 days without an LTI to the end of June. Moving on to slide 4 and the results for financial year 2019. Neil will shortly explain the financial results, but I am pleased to report that despite tough market conditions, the lithium business remains a low-cost, high-margin producer, and Orocobre recorded an underlying profit of $24.8 million and a group statutory profit of $54.6 million. The Olaroz lithium facility achieved a total production of 12,605 tons, which was up slightly on the previous year. We continue to follow our strategy of managing brine concentration to minimize impacts of weather, such as the lower than average evaporation rate that we experienced earlier in the year. We have also continued to build new ponds for stage 2, and this will now begin to contribute concentrated brine for stage 1 and help us to gradually increase production and the proportion of purified carbonate. We are fully funded to complete stage 2 expansion at Olaroz with the finalization today of a $180 million debt facility with Mizuho Bank secured by JOGMEC. Leveraging on the incremental pond area, we expect that production will be at least 5% higher than FY19 and will provide a further update at the AGM. In terms of market, we're still contending with low market prices of approximately $7,250 per ton for the September quarter. We will discuss this further, but we remain confident in the medium to long-term outlook for lithium. Finally, Borax continues to operate at or near all-time low unit cost of production and has managed to generate a small operating profit through improved sales performance. Thank you, and I will now hand over to Neil to run through the financial results.
Thank you, Martin, and a good morning to all. First up is the Orocobre and Olaroz joint venture structure slide. Orocobre has a 72.68% ownership in Sales de Jujuy Pte., which in turn has a 91.5% interest in Sales de Jujuy SA, giving Orocobre an effective 66.5% interest in SDJ SA. One of the transaction terms when Toyota Tsusho bought 15% of Orocobre in early 2018 was that Orocobre would gain control of Sales de Jujuy SA, which would then allow Orocobre to consolidate SDJ as opposed to equity accounting it. From 1 January 2019, Orocobre has consolidated SDJ. The statutory financial statements show 1 July to 31 December 2018 of the financial year being equity accounted and 1 January to 30 June 2019 being consolidated. In order to show what the full FY19 and comparative FY18 would look like, we have produced a consolidated profit and loss, balance sheet and cash flow in this presentation. Moving to the next slide, This slide details the consolidated profit and loss. The reduction in pricing has been the main contributor to lower revenues, with an average FOB price of US $10,322 a ton being received. Olaroz cash operating costs of $4,302 per ton are materially the same as FY18 of $4,194 a ton, excluding royalties, export duties, and head office costs, despite increased sales of purified product. A bridge of EBITDAIX from FY18 to FY19 can be seen in an upcoming slide. Gross cash margin remained robust at $6,020 a ton, or 58%. EBITDAIX includes $8.5 million related to export duties and $5 million of non-cash costs related to accounting for a change in control of Olaroz. Depreciation costs of $974 a ton versus FY18 of $741 a ton include the amortization of the uplift in value resulting from consolidating SDJ. The $30.7 million gain on consolidation is a once-off non-cash accounting gain as a result of Orocobre obtaining accounting control of SDJ PTE Group from 1 January 2019, given the assets had to be fair valued. Foreign exchange losses relate to VAT balances, which are Argentine peso based, and the effect of the US dollar strengthening against the Australian dollar and Argentine peso. The share of losses of associates relates to Advantage Lithium and the Naraha lithium hydroxide plant. The income tax benefit represents a reversal of dividend withholding tax to foreign shareholders of $13.1 million, $6.9 million due to the unwinding of deferred tax liabilities related to the lower statutory tax rate, 25 versus 30%, partially offset by foreign exchange differences. This resulted in a statutory profit after tax of $65.4 million. Moving on to the next slide, this slide details what our underlying profit is. In moving from the statutory profit of $54.6 million to an underlying profit of $24.8 million, we have made the necessary adjustments as detailed on the slide. The underlying profit of $24.8 million for FY19 is approximately 4% down from the FY18 $25.7 million underlying profit, which is mainly due to lower average lithium prices received, the introduction of an export duty during FY19, slightly higher costs largely offset by lower tax expense, lower depreciation, and higher finance income. Moving to the next slide, this slide details the bridge between EBITDAIX for FY18 of $86.7 million and the FY19 EBITDAIX of $54.1 million. The main component of the reduction is related to lithium pricing of $27.3 million and the export duty of $8.5 million, which was introduced in September 2018, with operating costs remaining well controlled. Whilst the lithium pricing and export duty have had a substantial effect on the reduction, EBITDA and the operating margin have remained strong. Moving to the next slide. This slide details what the consolidated balance sheet looks like for FY18 versus FY19. The column on the right for FY18 is what the consolidated balance sheet would have looked like before fair valuing the balance sheet due to consolidation, and the middle column shows what the balance sheet would have looked like in FY18, including the fair value uplift which occurred during FY19. The key points on the balance sheet are: cash is reduced given the funding of Stage 2 expansion. Inventory has increased mainly as a result of higher brine and finished goods inventory. Property, plant and equipment has increased as a result of the fair value uplift related to consolidation and CapEx related to Stage 1 and Stage 2 expansion. The investment in associates has increased due to the investment in the Naraha lithium hydroxide plant and Advantage Lithium. External borrowing continues to reduce. The principal on the Stage 1 project finance loan has reduced from $191.9 million to approximately $110 million at 30 June, and in 2 weeks' time will have reduced to approximately $99 million. Increase in net deferred tax liability is mainly due to the tax impact on uplift from consolidating SDJ, a reduction in carried forward tax losses, partially offset by the unwinding of the dividend withholding tax liability and reduction of lower statutory tax, moving from 30% to 25%. Moving to the next slide. Cash generated from operations remains strong, but lower than previous year due to the lower average sales price received and export duties. In detailing some of the main movements, net VAT changed from an inflow to an outflow year-on-year due to expansion CapEx, lower sales, and tighter government liquidity resulting in slower repayments. The purchase of property, plant, and equipment relates to sustaining and expansion CapEx. Investments in associates represents our capital injection into the Naraha lithium hydroxide plant and participation in the Advantage Lithium private placement. Repayment of borrowings is the reduction of the principal for the Stage 1 project finance loan. Loans from the shareholders received are from TTC to SDJ. In summary, a reduction of $55.8 million of cash, which in high-level terms is a result of the CapEx spend of $56.6 million. Thank you, and I will pass you back to Martín.
Thank you, Neil. On slide 12, I thought it worth briefly discussing Argentina. Things have been quite volatile over the last week or two, and while we don't know the outcome of the national elections until October or November, it is worth pointing out that Orocobre has been working in Argentina with both major parties in government at different times. We remain confident that either side of politics will be supportive of a strong lithium industry and exports in general. Also, we have seen from history that while currency and inflation can move considerably in the short term, they tend to cancel each other out over time. On slide 14, I have summarized how we intend to be a world-class supplier of lithium chemicals. We will continue to develop a deep understanding of our business with a focus on safety, quality, and productivity. Our existing strategic initiatives remain intact, with a focus on improving production from Stage 1, delivery of Stage 2 expansion, development of the Naraha lithium hydroxide plant, and development of the Olaroz basin and the very large lithium resources that it contains. We're also making some changes to our organization that will improve our management bandwidth and capability, which would help us to deliver on our vision. Moving on to slide 15, we are operating in a difficult market environment as we've seen a sharp price reduction and demand that is below expectations, creating an overhang in the lithium chemicals market. At the same time, battery technology is changing rapidly and customers' quality requirements are becoming more demanding. In this context, our strategy is to leverage our key competitive advantage, which is being a low-cost producer of lithium carbonate and to become a world-class supplier of lithium chemicals operating at the bottom of the cost curve. The outcome of this strategy is reflected in the profit margin. As I mentioned earlier, the cornerstone of this strategy is safety, and we will continue to improve our safety performance with implementation of best practice DuPont systems. My aim is that we will be a company with a strong culture on safety, because I know that it leads to the necessary improvements in quality and productivity. Safety and sustainability are increasingly important to our customers who want certainty in respect of ethical sourcing practices. In Olaroz, we're undertaking a number of quality-related projects to ensure we continue to evolve with our customer base. All of the quality projects have the potential to deliver better prices for our products. We have been working on productivity improvements which will deliver reduced costs through the lower use of reagents and better recovery of lithium throughout the process. We're also working to gradually increase the production of purified lithium carbonate. Additionally, the early delivery of stage 2 ponds will see extra evaporation and storage areas to help minimize the impact of weather and minimize production variations on a month-to-month basis. Considering our focus on safety, quality, and productivity, the priorities for improved operational performance at Olaroz Stage 1 are set out on slide 17. Brine quality will be improved to deliver higher lithium concentration and lower impurity concentration. Improved pond management practices are paying off with higher concentration brine in each prior corresponding period. Plant management will be key to deliver better results and development of new products in a landscape of changing customer needs. Moving to slide 18, in FY20, we aim to increase production and decrease overall costs so we can maintain and improve our current margin. This cost and production focus is essential within the current market conditions. We actively undertake maintenance at Olaroz during lower operation periods of the year to minimize the financial and production impact. This year, we are undertaking maintenance of the main reactors, which is expected to deliver further quality improvements. We expect the downtime to be offset with improvements in the plant efficiency and pond management. Moving on to the lithium growth projects, we start on slide 19 with the Olaroz Stage 2 expansion, which will supply up to 10,000 tons per annum lithium carbonate feedstock to the Naraha lithium hydroxide plant. Plus, according to the plant capacity, it will provide up to 15,000 tons per annum of high-quality, low-cost, primary-grade carbonate to new and existing customers. Construction is well underway with a number of ponds already filled and in operation, and we're incorporating all the lessons learned from Stage 1 into the Stage 2 design. At this plant, we will only produce primary-grade carbonate, and the operating costs are expected to be lower than those of Stage 1. Moving on to slide 20, the capital for expansion project is fully funded with existing cash and the announcement today of the completion of a debt facility with Mizuho Bank. The total facility for $180 million will have an interest rate and terms similar to the Stage 1 finance facility. One thing to note is that under the terms of the capital raise with TTC last year, Orocobre is required to hold approximately $135 million in cash term deposit until completion of this project. This cash will be available for cost overruns and other defined events of the expansion. Once completion has occurred, JOGMEC will assume 82.35% of the guarantee obligation, and that proportion of the term deposit will be returned for corporate purposes. On slide 22, during the final quarter of the year, we announced that Orocobre, Toyota Tsusho Corporation, and joint venture boards have approved the final investment decision for the Naraha lithium hydroxide plant to be built in Japan. Since then, as you can see on the slide, official groundbreaking has occurred and the construction is now underway. Veolia will build the plant, and commissioning is currently expected to commence in the first half of calendar year 2021. The Naraha lithium hydroxide plant will further cement our position as a global lithium chemical producer operating at the bottom quartile of the lithium cost curve. This plant will be the first of its kind in Japan and will provide us product diversification suitable for different battery technologies. It will also provide the opportunity for significant margin growth on our primary lithium carbonate being converted to battery-grade lithium hydroxide. And importantly, the plant is very close to an existing cathode manufacturer and planned battery manufacturing facility. Moving on to Borax Argentina on slide 24, it has continued to demonstrate improved sales performance, with their business development projects being converted into sales growth. Total tons sold were the best Borax has done in the last 6 years, even after deducting low-value mineral sales. The business is operating efficiently with unit costs controlled at or near record lows. Sales revenue is up nearly 15% year-on-year, and EBITDAIX is positive $200,000. Several long-term contracts have been secured with strategic corporate customers, which should help continue to deliver better results. That concludes the operating review, and I will now hand over to Tara to discuss our views on the lithium market.
Thank you, Martin. I'll begin the market section on slide 26 by discussing shifts in trade flows and pricing. Over the course of FY19, lithium chemical prices in the seaborne and China domestic market converged as China's demand growth slowed and the country's macroeconomic factors began to impact the broader global lithium market. Following the initial decline in 2018, China domestic prices were placed under increased pressure by a more stringent EV policy incentivizing higher battery energy density and range, requirements that could not easily nor quickly be met by China's domestic battery supply chain. In addition to these market-related factors, China's decelerating economic growth and escalating trade tensions with the US raised concerns of a current account deficit due to trade imbalances. With this in mind, the Chinese battery supply chain began to destock. During the December quarter, China became a net exporter of lithium carbonate for the first time in over 8 years, further encouraged by a price arbitrage toward the seaborne market and a reduction in the VAT from 16% to 13%. Chinese suppliers targeted markets traditionally served by South American producers, including South Korea and Japan, resulting in a significant inventory build. In response, ex-China markets sought out slower shipping rates. As a result, South American suppliers commenced trade with China, but at significantly discounted levels to meet domestic market prices. Heightened seaborne supply to the Chinese market and declining prices created more challenging conditions for the Chinese conversion industry. While spodumene prices declined significantly throughout the year, many Chinese conversion plants still held inventory of earlier, higher-priced shipments. In an endeavour to reduce working capital, Chinese conversion plants began to destock, requiring Australian hard rock producers to immediately delay shipments, restructure offtake agreements, and moderate planned production to manage inventories at the mine site and local warehouse facilities. Moving on to announced versus delivered capacity on slide 27. Throughout FY19, hard rock producers' endeavours to ramp up operations was met by resistance from converters who had struggled to bring on announced conversion capacity. The factors contributing to the differential between announced and delivered conversion capacity remain the same as in the past: underestimated project and ramp-up timelines, inconsistent or varied feedstock, and lack of experience and technical knowledge. While new and independent converters were most susceptible to these factors, integrated converters and brine operations also reported slower than expected expansions. Just over 50% of announced new capacity for 2019 has been released to the market so far this year, and much of this new production is still under customer qualification. Now taking a look at the industry costs on slide 28. As prices persist at levels lower than many expected, it has never been so important to be a low-cost integrated lithium producer. In a recent note, HSBC estimated that approximately 50% of 2025 supply is uneconomic at current prices, which primarily impacts new projects using feasibility pricing well above current levels. Our research suggests that approximately 15% of current supply is operating with costs above prevailing market prices. Independent converters remain the marginal suppliers to the market, despite reduced spodumene prices. As previously mentioned, the cost of production for some converters remains elevated due to spodumene inventory purchased during the higher-priced environment. But while industry expansion has come under pressure, lengthy project and ramp-up timelines, in addition to extensive customer qualification periods, leaves the market vulnerable to a supply shortfall given long-term demand fundamentals remain strong. Now moving on to demand on slide 29. A demand driver that is underestimated by much of the market, yet continues to add pressure to car manufacturers, is the carbon footprint of their supply chain and the penalties that will be imposed in the not-so-distant future. The more stringent and sizable penalties for carbon emissions in the European Union will be imposed in just 16 months. Under the new regime, a penalty will be imposed for vehicle emissions over 95 grams per kilometre, which compares to the current industry average of 118.5 grams. If the 2021 regulation was in operation in the European Union just last year, major car manufacturers would have been penalised a total of almost $40 billion. As a result, car manufacturers remain highly collaborative with upstream raw material suppliers. As for many, the potential carbon emissions penalties dwarf the cost of failing to invest in rechargeable battery and EV manufacturing facilities. Now finally, on slide 30, we take a look at how these supply and demand factors drive our forecasts. Orocobre's view of medium to long-term supply is underpinned by overstated capacity claims and underestimated project ramp-up and qualification timelines. Our view on demand has been instilled by downstream car manufacturers' commitments and battery capacity expansions. While there will be periods of market imbalance both on the demand and supply side, the company forecasts market growth of over 17% CAGR to 2021. And now I will pass it over to David Hall, who will discuss Orocobre's commercial direction.
Thank you, Tara. In relation to our current situation and our commercial direction, currently we have a high exposure to the Chinese market, and this is disproportionate to our longer-term goal and historical position where we have had a more even geographic spread of customers. This has had an impact on our weighted average price. In regard to the future, the target for long-term customer contracts is for 50 to 70% of volume to be secured under longer-term arrangements. These contracts will predominantly be with strategically important customers across the different market segments. Discussions on these arrangements are at different stages of progress, and current market conditions have delayed the timing of decision-making with some customers. We expect to make further progress on these discussions and conclude some arrangements during the traditional annual contracting season in the coming months. These longer-term arrangements will have diversity in commercial terms, which will mitigate a degree of risk of market volatility and provide better predictability of revenue and margins. In regard to joint marketing, in the past financial year, we formalised a joint marketing agreement with TTC, which provides for more direct involvement of Orocobre in marketing activities. This improves cooperation and clarity between ourselves and TTC in the planning and execution of market plans and in customer engagement. We're also in the final stages of recruiting an Orocobre manager to be based in Japan. That concludes the commercial summary. I'll now hand back to Martín.
Thank you, David. In summary, Olaroz remains a low-cost, high-margin producer despite current market conditions. We believe the medium to long-term market fundamentals are intact. We are profitable and fully funded to deliver our growth projects at both Olaroz and Naraha, and we have a clear vision and focus on continually improving our operational performance. Olaroz will continue to grow into a world-class lithium chemical supplier, delivering improved returns to our shareholders. Thank you, and I will now hand back to Lexi for questions.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you are on a speakerphone, please pick up the handset to ask your question. If you wish to ask a question via the webcast, please click on the Ask a Question tab on the top right corner of your screen. Your first phone question comes from Reg Spencer with Canaccord Genuity. Please go ahead.
Good morning, Martín, Neil, and Tara. Thanks for the chance to ask some questions. I've got a few, but I might start with Argentina. I was just wondering if you could provide some comments on the possible shorter-term impact to your cost base from local inflation. I know you guys have said repeatedly over time that over the long term, inflation and devaluation cancel each other out, but obviously there are short-term impacts and variabilities. What are you seeing in terms of the impact on your fixed costs at Olaroz from current inflation?
Thank you, Rick. As we said before, what we are used to seeing in Argentina is that in the long term, inflation picks up and covers all the impact of devaluation. What we have seen in the last week is a devaluation of approximately 30%. It's narrowing down. If you look at the numbers as of yesterday, that devaluation was reduced to something like 27% because the peso was gaining terrain again. The impact on our cost base is on the part of peso-based, which are mostly salaries, because all of our reagent costs and energy costs, since we generate our energy with oil, are highly dollar-related. So that impacts slightly less than half of our cost base. And Neil has run some detailed numbers, can tell you some more details about it.
Yeah, Reg, we've already done some fiddling around with it. I mean, it's an immediate impact, and we've got to see how things transpire over the coming months, given the elections in October. But with that devaluation, obviously, as Martin was saying, we've got roughly 45% in Argentine peso. That'll give us an uplift immediately. There's probably right as of now a $200 to $300 effect on our cost per ton in a positive way. You've also got to, if you remember when the export duty came in, it was about 8% of sales. That's 3 pesos per dollar. If you take the new exchange rate, I think the peso is trading around 55 to 1 today to the US. That reduces it to about 5.5%. So there are short-term benefits to be gained. Obviously, you do have devaluation of our peso-based assets and liabilities. So I think everyone knows with regards to that, we've also got assessed losses carried forward, which are an asset. It affects that. But then you've got payables, peso payables from one day to the next. You get an immediate benefit on that. However, you do have the catch-up once inflation starts catching up. So it's got to be monitored carefully. It changes from week to week, dynamic, and for us, there's an immediate benefit.
Okay, that's a positive. Just running with a similar theme and the short-term impacts on costs and margins. Maybe one for Martín, just your production strategy. I know previously you guys had suggested that you may look to do limited runs of purified product when weather conditions permit. I'm just wondering your pricing guidance for the September quarter. Does that include any material volumes of purified product? And going on from that, are you able to provide any sort of longer-term directional guidance as to where you think your purified volumes might track and what impact that might have on average pricing?
Number one is the purified that would be sold in this quarter has already been produced. So, there's a mismatch between sales and production. We produce according to our brine quality, and we sell according to our customer requirements. So we manage that with the stock that we keep within the company. We're continuing to focus on running more purified product during this year as we expect to increase the share from what we produced last year, moving towards our quality strategy. I think David can tell you a little bit more about the product split between purified and primary for the past quarter and for the past year and what we see for this quarter.
Yeah, Reg, last year the split between prime and purified was 73-27 in percentage terms. So we're looking to shift that more towards more purified product in FY20. For this September quarter, the proportion of purified product will be relatively low. It'll be around the 10% mark. But moving into the December quarter, that percentage will actually increase.
Okay, so from that, I gather you'll get a bit more colour from your contract negotiations looking into calendar 20 then, Dave. Is that fair to say?
Correct, Reg. As you know, we're moving into the traditional annual contract negotiation season over the next 3 months or so. So we'll have a much better view on the wrap-up for the December quarter and certainly what calendar year 2020 is looking like once we get a little bit further down the track.
Okay, that's great. I might pass it on. Thanks very much, guys.
Thank you. Your next phone question comes from Rahul Anand with Morgan Stanley. Please go ahead.
Hi, Martín and team. Thanks for the opportunity. Look, I might start with the first one on the additional ponds and sort of the production trajectory. If I may, how are those additional ponds coming online at the moment? I'll take it all of them would be full of brine at the moment, but how many of them are now ready to harvest? And what I wanted to really get to is how much of the additional brine that you've been planning is available within that FY20 year for you to be able to use. That's the first one, and then I'll come back for the second thing.
Okay, well, thank you, Rod, for your question. It's, answering your question requires a lot of things to be considered and factored in. Regarding harvesting ponds, we completed the harvest of the harvestable ponds of stage 1. So we don't expect to harvest more ponds from stage 1 for the next couple of years. The ponds for stage 2 are being built as we speak, and we already have something like 10 to 20% of the total pond capacity starting to be filled in and used for stage 1. Our production forecast for the year benefits from the usage of these ponds initially until the first quarter of next year, in which we will start to fill the ponds for the secondary, for the expansion project. Also, the production forecast incorporates incorporates certain conservatism. What we did is we looked at the evaporation rates over the last 3 years, and we picked the lower evaporation rate for every single month. So when you look at the production forecast that we are putting together, what it considers is it does consider using some of the ponds from stage 2 as they become operational. We're using them for stage 1 during part of the year, not throughout the whole year. It incorporates a conservative operation rate based on the experience that we have from the last 3 years. And it also incorporates the month of August and February running at a lower production rate, since we are undertaking major maintenance of the 2 main reactors that we have at the plant. So, all that has been incorporated into the production forecast for the year.
Right, okay. And then, Martín, if we move into the time then when stage 2 starts producing and you lose some of these ponds that are being utilized in stage 1, then how does stage 1 production look?
Well, it will depend on we are making lots of changes as we speak to the pond management system. I will tell you, we're starting to see, as I said in the presentation, that those changes paying off. We are seeing better brine concentrations with lower evaporation rates that we saw in comparable periods. We also are working on the focus this year is focusing on the profit that we're making, improving the margin and improving recovery grades at the plant. Also, it's reducing the cost of the usage of reagents. Once we factor all that in, we should be able to tell you how that is going to impact in the long run. We think that running both systems together should provide us a more stable brine coming through the year. And that is something that we will learn as we start to operate the whole system with all the ponds jointly operated. Difficult to tell you a number today. I think it is important to say that we maintain our objective to, by the time we have stage 2 in operations, stage 1 should be at full capacity, as close as possible to the expected capacity for that stage, and also focusing on purified production. We are factoring, there has been a discussion for some time about an evaporator being used. What we are doing is analyzing the use of the evaporator for both stages being pulled together, stage 1 and stage 2. That should bring economies of scale, not only in the size and cost of the evaporator, but also in the OPEX of such an equipment. That equipment, we don't need it during this year because we will leverage on the additional pond capacity, but it's something that we are thinking of for 2021.
Okay, and I take it it's probably too early to start talking about CapEx and benefits of that yet?
Yeah.
Okay. All right, I'll move on to the next one then. In terms of borax, now that you've taken charge, in your mind, what is this asset to you? I mean, does this still stay a core asset to the Orocobre business? And how do we think about? I mean, there is production guidance today that's an improvement, but we still don't have much clarity on margins, and at the end of the day, it hasn't really made much for a very long period of time. What are your views and thoughts about how this business fits into the wider sort of Orocobre group?
Well, the first action in borax was to stop the bleeding. We had a company that was losing money, and we wanted to put it in break-even and start making some money, which is what we are doing now. Clearly, when you look at growth perspectives of the borax business against the lithium business, and when you look at how to allocate your capex, usually what you do is you allocate your capex to the largest growing business, which is the lithium business. So in that regard, what we are doing with borax is, initial stage was to get the company back in black numbers. And, from there on, we'll continue to work to continue to improve or see where, it's a difficult market environment for borax and lithium today to look into more, more large business ideas or business discussions. The initial objective, which was to bring it to profitable basis, was achieved, and now we have to continue to improve from there.
Okay, so just confirming, so you are expecting the business to be profitable this year?
Yes.
Okay, brilliant.
Again, on a very narrow margin, as this year continue to improve, but you will not see a shocking profit coming out from borax this year. The borax market continues to be complicated in terms of competence and price projections.
Yeah, no, that'll be a good outcome if we can get it to break even and sustain it there. Final question then. If we talk about South American exports, there were some news items that came out of China from some trusted sources that I follow that there were some unpurified exports even coming from majors that produce in South America that then had to be reprocessed by some of the producers or converters rather in China. Are you seeing a similar trend, I guess, in the market that a lot of the brine producers are somewhat struggling to produce purified product and, because of that, just exporting unpurified and getting the Chinese to convert it? And what do you think about that as a potential trend into the future?
Well, what you have to think of that question in several aspects. One is that the margin for more value-added products has narrowed, and some producers have decided to sell their low-value product straight away without being processed at their facilities. Others, regarding the cost of reprocessing and else, I think Tara is much better prepared to answer that question than what I am.
Hi, Ro. Just extending on what Martin said, I suppose the most obvious example of that would be SQM, and SQM, what we've seen is that they've shifted their mix further towards carbonate versus hydroxide, and our view on that is that they're using, I guess, what they would usually use to process their carbonate into a hydroxide and using that and sending that, which is unpurified into China. So yes, we agree with what you're seeing and what you've said there.
Okay, brilliant. Thanks for that. Look, I'll pass it on. Thanks.
Thank you. Your next question comes from Joel Jackson with EMO Capital Markets. Please go ahead.
Hi, this is Bria Murphy on for Jill Jackson. Thanks for taking my question. I'm just wondering if you can talk about your contract strategy moving to longer-term contracts and your ability to secure these longer-term contracts as your output grade varies between kind of purified and primary grade.
Thank you, Julian. Let me pass that on to David. He's been talking about that.
Hi, Bria. There's probably a number of moving parts within that question. I'll attempt to address each one of them. In terms of the different product grades, we've had discussions underway with quite a number of customers across the different market segments in terms of longer-term contract arrangements, and these will be different in each customer case, largely related to the way that the customer runs their business and how they manage their risk and potentially back-to-back these contract arrangements with their own customers. So it's certainly not a one-size-fits-all type of scenario, and obviously customer requirements in terms of impurity control can vary not only within the battery materials market but also across those industrial and technical markets as well. So in summary, we've had discussions underway with quite a number of customers now for some time. Given the current state of the market, it's understandable that the progress on those discussions has slowed temporarily, given customer situations with high inventory levels and them reworking their own forward forecasts. But one thing I can say is that we've seen some positive signs from some customers in terms of increasing their volume requirements for not only the December quarter but moving into calendar year 2020. So we're quite comfortable, I suppose, with how those discussions are going, and we're looking forward to heading into the next sort of 3-month period, which is the traditional annual contract cycle, and concluding some of those arrangements. But as we mentioned in the presentation, the longer-term strategy is to get a percentage of somewhere between 50 to 70% under longer-term arrangements.
Thank you. That's it for me.
Thank you. Once again, if you would wish to ask a question on the webcast, please type your question into the Ask a Question tab on the top right corner of your screen. Your next phone question comes from Warren Edney with Value. Please go ahead.
Hi, thanks very much. I just wondered if you could just explain a bit about how the ramp-up and commissioning of Stage 2 and the hydroxide plant work. I mean, is it one of these things where you can ramp them both up together, or do you have to have the Stage 2 ponds all ready and potentially, I guess, the evaporator all online before you can process ramp up the hydroxide plant? Or would you buy feedstock for the hydroxide plant as part of the ramp up?
Okay, well, thank you for your question, Warren. The plan is to ramp up both plants together so that the lithium carbonate primary grade being produced in the expansion is the feedstock for the Naraha plant. However, the Naraha plant can also operate from lithium carbonate produced from Stage 1, which we are currently commercializing to other customers. So there's not a need for such a thing. However, the plan is to ramp up both plants together starting somewhere in the first half of 2021.
Okay, and I know obviously it's too early to tell exactly because you don't even know what the weather's going to be like in 2021, but is there a plan for how long that would be? Is it sort of an 18-month period or 12 months?
No, we are completing the detailed analysis of the expansion project, and the ramp-up is the last part of the detailed engineering that you do. I aim to have a ramp-up period of roughly 12 months to try to see and understand what the production capacity of stage 2 is going to be. Usually, you define nameplate capacities after you complete the ramp-up period, which is what we are trying to achieve with stage 2.
Okay, thank you.
Thank you. Your next phone question comes from Glyn Lawcock with UBS Investment Bank. Please go ahead.
Good morning, Martin. Just wanted to go back to the production guidance and the production itself. I mean, it's been 4 years now, and we're still well short of phase 1 nameplate. And you've got some ponds on operation now that belong to phase 2. Just want to be clear, do you feel comfortable that the design you've got can deliver the 42,500 tonnes, or are you still uncertain, you need time, and there's a risk that the plant footprint will need to change to achieve your ultimate goal of 42.5? I just trying to understand if you're comfortable yet, or you still need more time, and therefore there's risk of capex. And then secondly, just on pricing, you spoke a little bit about mix. I'm just wondering, I mean, with other input prices still spiralling lower, like spodumene, etc. Just wondering, I mean, in your discussions, do you think we're finding a floor yet, or do you think we're still trying to find that with what's happening in the market? Thanks.
Well, thank you, Glenn. To answer your two questions, number one is yes, we need more time, and as I said before, we will actually know the nameplate capacity of stage 2 once we ramp it up. So it will take us some time to know whether this, the total nameplate capacity of both stages put together is 42.5 thousand tons, or whether it's more, whether it's less. What's the capacity when you run purified product is different than when you run primary product today, because the recovery rates are different in the plant, but the plant can process one flow rate through it. So putting all those things together will tell you about the production capacities. What we are doing this year is we are not focusing greatly on increasing production during this year because the market is pretty tight. Our main focus is towards quality that should result in improved prices for our contracts, and improved purified production should improve the pricing, and that will move us to your second question. And at the same time, we're looking into reducing the cost because we think this is a year to protect margin. Margin is a cornerstone of our strategy, and it is the most important competitive advantage that we have, and we have not only to keep it, but to improve it over time. So that's the objective for this year. When we talk about pricing, it's very difficult to tell you whether we reach a floor or not. I think that the market said that this before. It's operating on a cash basis. People that are making cash returns on a monthly basis, they continue to produce. And as they continue to produce, we have to see at which is the level at which some of these spodumene producers will have to shut down operations. So far, what we have been seeing is delays in the shipments that are telling us that something is starting to change in the market. But I can't tell you that we reached the floor. And I'm using my own experience. I come from the oil industry, and I saw a movement like this about 2 years ago. And the strategy that I put in place at that point in time was making sure that we kept the profit up and running, because the only thing that will get you through a crisis like this is if you're a profitable business and you can continue to invest, which is our case. We're fully funded to complete stage 2. So by the time the market returns, we not only have increased capacity, but we also have the quality and the low cost to take advantage on that profit.
Okay, thank you.
Thank you. Your next phone question comes from Chris Chill with Quest. Please go ahead.
Chill. Thanks. Just you mentioned a major maintenance program, March quarter. Could you just tell us a bit more about scope and duration of that, please?
Well, basically, we are doing the maintenance of the 2 main reactors. That is something that we're doing to improve the quality of the product that we're producing. We're taking one of the reactors out of production during the month of August, and the second one will be taken out of production during the month of February. We picked those 2 months because they are historically have been the lowest evaporation months, so that the financial impact is as low as possible.
Okay, and you talked about the 5% target, and I appreciate your comment on quality, but you also talked a lot about costs. Can you give us any sort of forecast on, with the 5% increase in volume, how you see the margin moving?
Well, the margin will depend a lot on the price, unfortunately, and it's difficult to tell you something on the price. What we are trying to do is to have that margin increase and quality improvement in the product, as well as increase in the share of purified product with the same cost as we had last year for a lower amount of production and lower share of purified. So that's the objective, and the objective is to continue to improve the cost, because as said before, the only thing that keeps you up and running, even in tough market conditions, is to protect your profit, which is what we are doing. We want to continue to be a low-cost, high-margin operator, and that's the name of our business.
Okay, thanks.
Thank you. As a reminder, if you wish to ask a question on the webcast, please click on the Ask a Question tab on the top right corner of your screen. Your first webcast question is, on the demand side, is the price/performance ratio of LIB batteries improving significantly?
I think that I'll pass it on to Tara. She's better prepared than I to answer that.
Hi, Lexi. I suppose when we're talking about performance, the key parameters that the market looks at is energy density and range, and certainly the market is, battery manufacturers and car manufacturers are getting greater energy density and range out of their batteries. The thing that is confusing the market, I suppose, or concerning the market is the pace. With regards to, I guess, the ratio of cost to performance, it's certainly improving. The biggest driver of a reduction in cost is the raw materials, and we've seen, obviously, there's been a reduction in the price of lithium chemicals, in cobalt and in nickel. So that's certainly resulting in a significant decrease in the cost for lithium-ion batteries. And in terms of performance, even though it's been a slow shift to the later, or the more advanced nickel-based cathodes, it's certainly moving towards the higher nickel content cathodes, particularly outside of China. But with the relaxation of the restrictions around foreign companies participating in the Chinese market, we'll see that some of the capabilities of ex-China battery manufacturers and EV manufacturers will start to infiltrate the Chinese market.
It's probably worthwhile just to add as well that there has been quite significant investment from some of the major battery producers in existing cathode formats with some very, very good gains in efficiency. So, when you look at the 622 cathode formats and 523, there have been some great leaps forward in terms of, the efficiencies of those cathodes, and there's been investment on the anode side as well that has delivered, vast improvements in battery efficiency. So, there's also gains in the battery chemistry as well. So there's a lot of focus on it in the industry, and it's rapidly heading in the right direction.
Thank you. There are no further questions at this time. I'll now hand back to Mr. Pérez de Solay for closing remarks.
Thank you, Lexi, and thank you everybody for participating in this call. Look forward to continue discussing with you whatever you need. Thank you.